Good afternoon, everyone, and welcome to today's complimentary webinar focused on tracking two key risks, U.S. equities and China. This is going to be presented by Dr. Lev Borodovsky, the Chief Risk Officer of Star Mountain Capital, and Lev is also the editor of the Wall Street Journal's The Daily Shot. My name is John Polis, and I'm the Chief Operating and Technology Officer for your webinar host, Star Mountain Capital. We are a specialized asset management firm focused on investing in the large and underserved U.S. lower middle market of companies with typically under $15 million of EBITDA. Our differentiated business model includes a custom-built media and technology platform, bringing proven large market resources to smaller businesses as a value-added lender and investment partner. Before I do hand over the reins to Lev, I did want to let you know that your audio is muted and will be for the entirety of the presentation. Also, as a disclaimer, I wanted to note that nothing presented in this webinar or in any of the webinar materials we will be sending you constitute an offer to sell or a solicitation of an offer to purchase by Star Mountain Capital interest in any investment product. We have allocated time at the end of the presentation for Q&A. If you do have any questions, please type them into the Q&A chat box of your WebEx client. We will try to get to as many questions as possible before our time is up. Now about our presenter. Lev Borodovsky has over 20 years of experience covering private equity, risk management, and operations. He was a founding member, chief risk officer, and managing director of the GSO Blackstone platform, one of the most successful global and loan investment platforms. Currently, Lev is the chief risk officer at Star Mountain, and he's also the editor of The Daily Shot, a chart-based newsletter covering select global economic and market trends that is now part of the Wall Street Journal. Lev, I think this is our fifth or sixth webinar today. We're excited that you're here today. Why are we starting at 2:15 as opposed to 2 o'clock as per normal?
We're starting because the Fed just raised rates, so we wanted to take a look at what actually happened and maybe have a little chat about that as well.
Great, great. So looking forward to this presentation as always.
Very good. Thanks, John. Thanks for the introduction. So before we get started, again, the Federal Reserve just raised rates. And this is the third rate hike this year. There's not a lot of surprises. This rate hike was fully expected. If you look at kind of the projections from the FOMC, again, no major surprises. We do know that the market fully expects a fourth hike this year in December. In fact, here's the probability, market-based probability of another rate hike, the fourth rate hike this year, and it is it's been above 70% for some time. So this year we're looking at 4 rate hikes, and so the question becomes, what happens next year? If this pace of rate increases continues, that's going to have a material impact on the economy and the markets. So let's proceed with the presentation. Just taking a step back, I've been asked a lot, what types of things I'm seeing that are top of mind. What are the things that analysts, strategists, investors are concerned about? And obviously there's a laundry list of things, but there are 2 issues that people want to learn more about and get a feel for. One is, we're in the midst of the longest bull market in the U.S. Equity markets. It's the longest bull market in history. And the question is, what makes it vulnerable? What are the things that keep strategists awake at night? What could trigger the next sell-off? And some people ask when could that happen potentially. So that's kind of the key theme, number one. And number two, what signals are we getting from China? There's talk of a slowdown there. There is, but so far there's no evidence that the economy is cratering. The reason why people worry about China is that it's not just that we'd have one of the largest economies in the world. It is that a slowdown in China will reverberate globally, and will ultimately end up back in the U.S., meaning that it's not an isolated effect. It's not like the U.S. can continue to grow in isolation, whereas if China really has a significant downturn. The global economy is interconnected, and far more now than it has been in a long time. And so it's not one of these things that can be ignored. So we'll talk a little bit about the mixed signals coming from China. So let's start with what keeps U.S. equity strategies awake at night. When they look at this market, what are the indicators that make them nervous? And again, as a reminder, I'm not going to be, I don't want to spook anybody about their investments, or I'm not saying sell your positions or anything like that. In fact, I've been constructive on the U.S. stock market for some time. The issue is I'm hearing from a lot of analysts, a lot of researchers, and this is sort of a laundry list of what I'm hearing from them that makes them uneasy. So let's start with valuations. No matter what measure you use, U.S. stocks are not cheap. Whereas you use trailing P, forward P, price to book, price to sales, U.S. shares are not cheap. The question is the market stretched? And there's debate about that. There's still a lot of bullish investors out there who think that the market is by no means overpriced and has more room to go. I mean, one indicator that stands out is the S&P 500 price to sales ratio, which has reached the highs of the highs of pre-dot-com bubble burst. So that's one indicator that makes people a little bit uneasy. But if you look at sort of the regular forward-looking price-to-earnings ratio of 17, it's again not cheap, but it's not outrageous by any stretch. The market could surprisingly, this surprised a lot of people. The market continues to brush aside the escalating trade war. This people sort of think, oh, okay, well, we had some tariffs and nothing happened, so what's the big deal? Well, the tariffs we had so far are only a small portion of what's coming, right? So at the end of the year, we're going to have the latest 200 billion of Chinese imports. The tariffs will go from 10% to 25%, and then there's threat of an additional, basically the rest of Chinese imports get hit with additional tariffs. And so we're going to be hitting all of China's imports with significant tariffs. I don't know if you live in Middle America like I do in Pennsylvania, and you go to a local store like a Dollar General, probably 90% of stuff sold there comes from China. So we're going to see price increases, and potentially spook the consumer, which could have all sorts of nasty implications for the economy. By the way, this chart on the right is kind of an estimate from Oxford Economics as to what will happen next year in a full-blown trade war scenario in terms of the impact on the GDP growth. As I said earlier, we have the 200 billion tariffs that went up, and that's, if you look at what kinds of products that constitutes, a lot of it is sort of capital products, machinery, equipment, and intermediate products. Only a portion of that, and that's this chart here, only a portion of that, it's around 2, is consumer products. That last round, which is going to hit the rest of the imports from China, that's called round 3, that's going to slam all consumer products, from phones to TVs to clothing and furniture and things like that consumers buy, and so that will have a real impact. But so far, the markets either assume that this will be avoided, which I'm not convinced it will be, or they don't believe it's going to have a material impact on earnings, which again is hard to imagine. Of course, we saw the Fed hike rates, but it's not just the short-term rates that are rising. I mean, you can see on the left side here, the 2-year Treasury bond yield, continues to hit highest levels in years. But it's not just that. On the right side is the 30-year mortgage rate, which hit a 7-year high, I think, this week. And that's sort of 4.7%. 30-year mortgage is still not bad, but consider the fact that house prices have risen pretty quickly and continue to rise at sort of 6% a year nationally. And so home price increases have definitely outpaced wages, and now you smack them with high mortgage rates. It could have a pretty negative impact on the housing market. Here's an example of what the stock market is already seeing just related to interest rates in the housing market. This is an index of U.S. home builders, and in blue, and the red one is the S&P 500, and you can see the sharp underperformance of the housing market, which I view often as a kind of a leading indicator for the economy. And so the market is saying, investors are nervous about what's going to happen in the housing market, and could this have broader implications for the stock market? Remains to be seen. It's interesting because people said, well, higher rates should boost bank shares, because as rates rise, the interest margin for banks improves, and that's been the case kind of earlier on, but now with this big spike in mortgages, for example, higher rates on credit cards and other sort of consumer debt, some people are concerned that even though margins are improving, the demand for loans could slow down, and so you could have a the banking sector could underperform as well, in which it has been doing somewhat already. And again, the banking sector is often a leading indicator for other sectors, especially in the downturn. So the other issue about rising interest rates is it makes cash much more competitive. I mean, your 1 month Treasury bill is is over 2% now, right? And so if you put money in a Treasury money market account, you're going to outperform the dividend yield of the S&P 500, which is the left chart, right? So these higher stock prices and higher Treasury yields make cash increasingly more attractive. And by cash, I mean short-term treasuries, like a Treasury money market fund. So you're basically taking no risk and getting your 2%, or you get less from a dividend yield in the S&P 500 and taking a lot of risk. Now, of course, people don't buy the S&P 500 for dividend yield; they buy it for earnings growth. And if you look at the earnings yield, which is kind of the equivalent of, assuming that you were receiving those earnings, what would be the yield of the S&P 500? That's obviously still higher than cash, but that differential has been shrinking. And so, at some point, some investors on the fringe will start saying, you know what, I like cash more, and it could result in a rotation out of the stock market. So we're starting to see the effects of the tax cut coming out of the earnings universe, right? So for the first time in a while, we're seeing a lot more companies basically saying that potentially could have their earnings could decline and moderate, and so you have the bottom left chart, the red one, shows there are more companies sending out issuing negative earnings per share guidance, and fewer companies issuing, in the upper left, fewer companies issuing positive earnings per share guidance. And so the companies are sending a message to say, look, this growth in earnings that we had, which is a lot of it, which is tax driven, is not sustainable, and they're saying, this is not gonna last. I mean, again, let me step back and say, to be sure, that U.S. companies' earnings and growth has been tremendous, and it probably will continue to be. But companies are sending a caution message to the market. And on the right side, you see the analysts, equity analysts, and this is a consensus estimate for the fiscal 2018 earnings per share, starting to moderate some of their earnings projections. So we can see some of these signals in the market saying, this party is probably going to last, but it's not going to be as festive, right? So that's kind of a way to describe it. Other analysts are concerned that the breadth of this market has been pretty narrow. So if you look at this chart, you see that 20% of the return has been attributed to top 10 companies, and that's pretty high. So it's the top 10 companies in the S&P 500 that drive performance, and that again makes people nervous. If you have a hiccup in Apple or something like that, you could have a significant impact on the overall stock market. So another reason why the stock market in the U.S. rallied despite the sell-off abroad is investors thought, well, the U.S. is the safest place because the economy is less impacted by trade. So in the case of a trade war, the U.S. is the best place to be, right? That doesn't mean that the U.S. market will continue to rally. It just means that relative to the rest of the world, it's the best place to be. And interestingly enough, this rotation out of the rest of the world into the U.S. was what drove the kind of the recent leg of the rally, where people saying, well, I'm going to take money out of emerging markets, I'm going to take money out of Europe because I'm concerned that the trade war will hit both harder than it will hit the U.S., so the U.S. looks better on a relative basis, and so people rotated into the U.S. And you can see the fund flows. The top chart shows fund flows into the U.S. The next one is into developed markets, ex-U.S., and the last one is in emerging markets. You can see outflows out of the rest of the world into the U.S. Question is, A, is it sustainable, and B, does it necessarily mean that the U.S. market may continue to outperform the rest of the world? That doesn't mean it will continue to rally. The other reason why we've had such a strong market this year has to do with buybacks, share buybacks by companies who use their tax breaks, tax reductions, to pay off investors, right? And so buying back shares has been the most common way to pay back investors, and that's driven that contributed to the rally this year. So this chart shows announcements and actual buybacks, and that's been it's spiked to record levels. Again, the question is this sustainable? Again, because of the rotation from the rest of the world, the U.S. market has outperformed most major asset classes. If you look at what other asset classes have done this year, whether it's starting from the left, emerging markets took a hit, gold, the developed markets, ex-U.S., emerging market debt, corporate debt. High yield is up actually a little bit, but other corporate debt is not. Treasuries are down. And so the U.S. market stands out as the outperformer. And again, some analysts question whether this is sustainable. For those who like technical analysis, the technicals for the S&P 500 don't look great either. We're kind of at the upper boundary of this channel, that we've had for a couple of years that's been sustained. And so the question is, you know, will we break above that upper boundary? Can we stay at the upper boundary? And so technicians are concerned that this is going to drop lower, at least to go to the middle of this channel. I think, to me, the biggest concern is the complacency that's set in this market. And yeah, I've seen other analysts sort of describe this as well. And you can see this in multiple areas. There's a couple of examples here. So, if you look at the chart on the left, it compares the two indices from Goldman Sachs. One that tracks companies that spend a lot on capital expenditures and research and development, and the other one that basically does stock buybacks and dividends, right? And you can see kind of in recent months, the total return index, which focuses on buybacks, has been outperforming. So investors are just focused on sort of short-term total return, meaning that companies that do buybacks and dividends, they're really not concerned as much about longer-term companies' growth. And so they're rewarding CEOs for returning cash to investors rather than investing in companies' growth. And that, to me, that's an indication of kind of short-term focus on the markets. It's hot money, basically looking for short-term gains rather than long-term investors. So that's the chart on the left. Chart on the right, this sort of same thing, two indices from Goldman Sachs. One tracks companies in the S&P 500 with weak balance sheets, and the other one with strong balance sheets, right? And for a while, when we had kind of some nervousness in the market, companies with stronger balance sheets have outperformed. That's the red line. And but now you see companies with weak balance sheets that are more leveraged and potentially provide better return, you know, if earnings improve. So weak balance sheet companies have been outperforming recently. And so again, investors are less focused on on the kind of longer-term risk and more focused on can I get a boost from leveraged companies? The operating leverage can boost earnings. Okay, so these two are kind of subtle measures, but to me they indicate aggressiveness in the market, increased risk appetite, focus on short-term gains, and a little bit of a kind of hot money flows into certain companies. Other areas where we see complacency in the stock market are things like hedge funds. If you look at long-short hedge funds, are pretty long the market. They were very long the market, sort of record levels long the market going into this year, at the beginning of the year. Then we had the volatility blow up, and they went more into neutral territory as a result. But now they're back, right? And so long-term equity hedge funds leaning much longer is an indicator of increased risk appetite and maybe complacency. we see similar trends for mutual funds and risk parity funds and other types of sort of speculative or fast money investors. The chart on the right shows the speculative positions or non-commercial positions in VIX futures. So VIX futures track the implied volatility in the S&P 500. And so it shows that these accounts were very short volatility going into this year. And then as we discussed in the previous couple of webinars, we had a volatility blow up in early this year, and it basically blew out a lot of these short positions in volatility. Why do people go short volatility? Well, because it's a positive carry trade. If you short volatility and it decays, so, you know, it's basically like shorting options. You short an option, if it never goes in the money, you own the premium. So as time goes on and the option is not in the money, its premium decays, and you collect that premium. And so with volatility, people short VIX to collect that carry, that decay, but they obviously risk a spike in volatility, which would happen in January. Well, now they're back, right? These short positions are back, and speculative accounts are shorting volatility again. And again, it's becoming pretty lucrative, right? Because you just sit there and collect your carry as VIX futures roll down the curve effectively. And that's an indication to me of increased risk appetite and some complacency. Okay, so we spoke about kind of the issues that I'm seeing from other analysts in the stock market and what are the concerns, and I do want to say that overall, again, I'm still constructive on the stock market in the U.S., but there are these rising concerns to think about. So let's turn to China, and it's obviously related to the U.S. stock market because these are the two economies, and the world economy is pretty interconnected. And there are obviously risks to the U.S. stock market from China. Just as an example, when in 2015, when China had a sharp devaluation, the U.S. stock market sold off rapidly. And so if you see some sort of an event like that again in China, you could have an impact on the stock market. So far, the recent devaluation of China's currency did not impact the stock market in the U.S. negatively. And people sort of think, oh, okay, so maybe we can ignore that. But there's other considerations. All right, so mixed signals from China. You know, there's debate about the trajectory of China's economy. These charts are from World Economics, and they're for September, showing what's going on in the manufacturing sector. They survey sales managers at China's factories to see if things are improving, getting worse, and how they view their part of the market, how they view sales, and so on. And if you look at these charts, the upper right is a particular concern. It shows that business confidence in China has deteriorated quite dramatically. And there are obviously concerns about growth in the manufacturing sector in general. Some of that, some would say a lot of that, has to do with the U.S. tariffs and generally a slowdown in global trade. So so these indicators, make one pause and think about what's really going on with China's economy. So this chart is from Goldman Sachs, and it shows what they call the current activity indicator. And it's a kind of a real-time measure of economic activity in China. So this indicator doesn't have to wait for the official GDP figures and can provide a tracking mechanism for what's going on more in real time. And it already shows a bit of a slowdown in the economy. Nothing dramatic, nothing like we've seen in 2016, but there is a slowdown. So analysts stock analysts are starting to downgrade China's corporate earnings, and again, still very high growth in corporate earnings, double digits, but not nearly what we saw at the peak. All right. At the peak, corporate earnings were expected to be in the 30s as far as year-to-year earnings growth, and that's coming off pretty sharply. Again, no losses here. We're not seeing again 2016 scenario, but it's off the highs. But then we have some other surveys from China that don't look bad at all. So this one is from a company called the China Beige Book, and it does surveys of companies across China on a quarterly basis to see things like sales and profit direction and capital expenditures. And what they're saying, okay, in this quarter, there's a little bit of a slowdown in earnings and sales growth, but it's not dramatic at all. It's just what looks like a small fluctuation. So nothing to really worry about. Moreover, if you look at the chart on the right, the capital expenditure trend continues to improve. So, at least according to this analysis, CapEx in China keeps improving, keeps getting better. So companies are investing in equipment, factories, machinery, and so on. Which is a very positive indicator for China. Overall, if you think about the investment process at the national level, there's a fixed asset investment, and by fixed asset investment, people mean things like buildings and roads and bridges and so on. You have a kind of a diverging trend. The fiscal stimulus, the government stimulus, where government funded all these massive projects, especially infrastructure projects, that's slowed down dramatically. In fact, it's stalled. It's not growing anymore. still there, it's just not growing anymore. And so you can see that the big spike in 2016 in fixed asset investment, which is when Beijing said, okay, it's time to stimulate the economy using, you know, fiscal measures, meaning government spending. And you had that spike, and that stabilized the economy, and then they kind of pulled back from that. And so you see that slowing. But private investment growth is stabilized. You know, it's just sort of below 10%, but it seems to be stable. That's the dashed line on the left chart. The right chart shows where the money is going for fixed asset investment, and you see kind of a slowdown in infrastructure, growth, a contraction in real estate and construction growth, but manufacturing expenditures for infrastructure expenditures continue to improve, and that takes you back to actually the previous slide where you see capital expenditures improving. So this is consistent with the red line on the right side here, showing that manufacturing fixed asset investment, where people building, you know, factories and facilities and so on, is actually accelerating. So this doesn't show us a significant pullback in private activity, private investment at all. What concerns a lot of economists out there about China is the slowdown in credit growth. So last year, Beijing, the central bank, PBOC, started tightening and has tightened policy quite a bit in order to rein in all the leverage. So the private sector has been becoming very levered. In particular, there's a lot of leverage in what they call shadow banking, or financing using non-bank sources, and so the central bank started curtailing that and tightening, raising rates and tightening the monetary policy, which is resulted in a slowdown in credit growth. And as this chart shows, that the economic activity in China is highly correlated with credit growth. It's become a credit-driven economy. And so the question is, you know, will this continue to slow? So this particular chart doesn't bode well for the economy going forward. However, in recent months, the central bank started easing. We saw them cut the the reserve ratios for banks. We saw them inject liquidity into lending markets, lowering the interbank lending rates without officially announcing, you know, rate cuts. They basically went ahead and created rate cuts by introducing liquidity. With China Central Bank, it's not as much of what they say as what they do, right? Because their communication is just terrible. And so they've been easing quite a bit, right? And part of the easing is due to the tariff threat, right? They view the tariff threat as having a significant drag on growth, and so they're like, you know, time to ease, right? Time to ease policy. The decline in the yuan was one of the aspects of easing is, weaker currencies is helpful for the manufacturing and export sector. But they don't want to let that go too far because a weak currency has other negative implications for the corporate sector. Some corporations borrowed in dollars, and when the yuan declines, those dollar liabilities become bigger when translated into domestic currency. So they don't want the currency to fall too much. But there are easing, and they continue to maintain easier monetary policy. Nonetheless, they're still trying to pressure the what they call shadow banking sector, right? So if you look at growth in shadow banking or non-banking finance, they're encouraging corporate bonds. They're also encouraging municipal bonds or local government bonds, which is a whole other topic. But they're discouraging other types of financing that increases leverage, and you can see the decline in growth or contraction in the overall volume of these types of products. But this monetary easing that they've undertaken recently is expected to boost credit again, increase lending, and there are signs that we're already seeing this, that lending's picked up. And so it's a bit of a balancing act for the central bank. They want to discourage leverage, but they also don't want to squeeze the economy by snuffing out credit. And so it's a bit of a balancing act how they want to do it. But right now their goal is to encourage lending, especially to smaller enterprises and so on. In fact, the People's Bank of China is undertaking what the European Central Bank called targeted LTRO, basically a way to encourage financial institutions, banks, and so on, to lend into the small business sector or middle market businesses. And based on that, the analysts and economists expect basically monetary conditions to push credit higher, right? So what they call credit impulse is expected to rise or improve going forward. And these two charts are from two separate institutions. One is from Goldman, and the other one is from Oxford Economics, and they're both basically saying, look, this monetary easing that's been taking place should boost credit, and as it boosts credit, it will stabilize the economy. Of course, the biggest uncertainty is this trade. If we're looking at a 25% tariff on 200 billion of Chinese exports to the U.S. plus, the rest of the Chinese trade with the U.S. getting hit with tariffs as well, there isn't a whole lot the central bank can do to stave off the slowdown. The slowdown will happen, but they will obviously keep easing to cushion this downturn. So if this kind of worst case scenario plays out, this chart shows significant shock to the economy of China, economic growth, especially next year and in 2020. right? So these are not immediate effects. This is not going to happen overnight. The slowdown will happen over a couple of years, and it could be significant. And this is the biggest kind of concern right now. And obviously, Beijing is well aware of this and is looking for to open alternative trade avenues, improve domestic demand, and ease monetary policy to cushion this correction. So we're also worth noting that the shock is not limited to China or to the U.S. In this global economy, you see, obviously something like Hong Kong getting hit, but also you'll see an impact in the Eurozone and Japan, as sort of secondary effects due to this trade war, escalation of the trade war. So those are the concerns. So once again, I just want to reiterate, there is no evidence of a major slowdown in China. There's some. It's the growth isn't as vibrant, but it's there. It's still going faster than the U.S. And for now, the immediate risks are relatively low. The issue is what happens next year or the year after. So that's it for the presentation. I just want to close by saying here are the various organizations that whose charts have been used in this presentation. I just want to thank them for their contribution to this. And finally, one note, people interested in the daily shot, this is where to find and how to sign up for the letter. All right, I think we're all set.
Great, Lev. We're going to open up some questions. So continuing on that last slide that you did, slide 29 on the impact of tariffs on China. Besides what you mentioned, what are some of the other impacts or effects of our tariffs on China over time?
Yeah, so obviously they'll have to rethink their dependence on exports, and they have been pushing it. That's not easy for them to do. The economy still, there's certain regions of China that completely depend on exports, and so there'll be a rethink there. But in the end, they'll be looking for other markets. And what will end up happening is that this bilateral tariffs are not always effective because China will just shift production potentially to other areas like Vietnam, the Philippines, or elsewhere, and or basically use those other locations and countries to move its product to ultimately get it into the U.S. And the end result in the U.S. will, the consumer will pay more for the product, but they will be able to get the product to the U.S. through other channels. And so the goal will be to reshuffle the supply lines and change the flow of product so that Chinese products gets to the U.S. through some other ways. Mm-hmm. But I think that's kind of the major impact of the tariffs.
Sure. And then circling back to the chart where you showed that investment in U.S. manufacturing has not been impacted. Is that partially a result of the Chinese trade policy?
So far, manufacturing investment has been continues to get new money. Some of it could be momentum, right? these factories are saying, okay, if we just take last year's growth and we want to repeat that, we're going to need, 2 new facilities. Okay, let's invest in 2 new facilities. But so far they're just ignoring the kind of potential slowdown and potentially thinking we'll find a way to get product into the U.S. It's puzzling, actually. It's puzzling that there hasn't been a more cautious reaction to what's going on.
China still holds an interesting card in that it owns so much U.S. debt. How does that factor into all of this?
It's a good question. Will China weaponize its treasury holdings, right? And if you look at the media, there's a lot of hype about this. Oh, they're going to start dumping treasuries. So China has two monetary levers against U.S. treasuries and the currency. And the currency, we already talked about this. They can weaken the currency, which they have already, and it will help them to mitigate the tariffs. Basically, if you have a 10% tariff and the currency falls by 10%, the tariff doesn't do anything, right? It's offset. But they're very concerned about the currency depreciation because of other issues. The weaker currency for China will create concern for borrowers in foreign currency. Again, so if you're a company, your statement, your financial statement is in yuan, right? But you borrow dollars, and so when you show your liability on your financial statement, you take the amount of dollars you borrowed, translate them into yuan, and show that as your liability. Now imagine the yuan is down 10%, right? So now your liability is all of a sudden up by 10%, and your financial statements, your balance sheet gets out of whack, and you look like you're bankrupt. So people worry about depreciation in yuan impacting, the non-dollar debt borrowers. Mm-hmm. But going back to treasuries, it's a similar issue. So if you, China has foreign reserves in dollars, right? So basically, the central bank holds, a massive amount of dollars, trillions of dollars, right? What do they do with those? They have to hold them. They have to keep dollars there. What do they do with them? To reserve like any central bank has foreign currency reserve. You can put them in a U.S. bank and keep them in a deposit account, which is not safe and nobody wants to do that. You can buy other U.S. assets with that, but you're really the only choice is to put it in treasuries, unless you want to buy U.S. corporate bonds, which obviously the Chinese central bank doesn't want to do. It doesn't want to take any risk, right? So what do you do with that cash? It's not like a household where I can go and sell bonds and buy something else. They're forced to hold these dollars, and so what do they do with those dollars? They have no choice but to buy treasuries. The only thing they could possibly do is shorten the maturity of their treasury holdings, meaning sell the longer dated treasuries and buy shorter dated like bills. But their average maturity is already like 4 years or something like that. They're already pretty short. So, if they want to steepen the U.S. yield curve and punish, U.S. mortgage borrowers, there's not much room for. There's not much they can do to accomplish that. The roll from their 5-year notes to 2-year notes, yeah, it will have a marginal impact on the treasury market, but not that dramatic. So weaponizing treasuries is a little bit overblown by the media.
Okay. Circling back to the beginning of your presentation, and also I think back to our last webinar, what catalysts could trigger a U.S. equity sell-off, and we spoke about this last webinar. How long will the bull market continue?
Yeah, it's I keep getting those questions, and they keep popping up, among all the analysts. So what's kind of the immediate things that could trigger a sharp sell-off in the stock market? One is, we got the elections coming up. Let's just assume, for example, an unlikely but a non-zero chance scenario that the Democrats take the House and the Senate, right? Now all of a sudden you have the risk of serious confrontation, a constitutional confrontation between the Trump administration and Congress. I'm not necessarily saying it could lead to impeachment, but the risk of that is now rises, right? And so all of a sudden you could have a sharp sell-off in the market. For example, again, the probability of that is relatively low, but it could become one of the risks. There are other risks. For example, a conflict in the Middle East pushing oil prices through the roof, where gasoline prices climb and the consumer pulls back, right? You could have sort of related to a political issue where you have a form of constitutional crisis where there's some sort of threat to the Trump administration, and that could spook the market. There's plenty. Now, obviously, rates is kind of the big one now, but the Fed has been pretty clear about its rate trajectory, very transparent. So I think the market is relatively calm, that they won't see any surprises. But if all of a sudden we see a spike in inflation, for example, in the next couple of months, and the market starts thinking, rather than pricing in 1 or 2 rate hikes next year, now we'll have to price 4, that will send the market lower. Sure. So these are some of the things that kind of people worry about.
Sure. And related to that, this is our last question, circling back to our last webinar where you spent so much time discussing volatility of the dollar. So we've seen some changes since then in the dollar. It's stopped rising, right? It's leveled off.
Yeah.
So can you provide some commentary on that at this point in time?
Yeah, people are wondering why the dollar hasn't risen further. If you look at the broad-based dollar, meaning not just against kind of the developed market currencies, but against all the trading partners, it continues to kind of creep up, right? It's trending higher. In fact, the dollar has risen quite dramatically against Asian currencies. With regard to developed markets, there's question as to why it hasn't climbed as much as people thought. And one of the reasons is people thinking, well, rates are probably going to start to rise elsewhere in the world, right? You see Canada and the UK, raising rates, and even you saw Norwegian central bank hike rates, for example, recently. And then you have the European Central Bank is going to end its quantitative easing by the end of the year. And so if you have higher inflation in the Eurozone, for example, and a more aggressive European Central Bank, and it doesn't take much, the dollar could fall. And so that's why people are not as bullish on the dollars as they may be. But if you look at it in general, speculative accounts still believe that the dollar has ways to go. So this is just a pause. And so hedge funds are net long the dollar. And so, people still believe it will continue to rally.
All right. I think that's all the questions that we have. Lev, these hours are always great. We appreciate the time that you put into this. The audience, our audience, is always very thankful for it. For those who signed in, thank you very much for joining us. Should anyone have any further questions or feedback, please feel free to email them to us at webinars@starmountaincapital.com. We will be emailing everybody who signed in today, tomorrow, with a PDF of Lev's slides, along with a link to the replay of this webinar as well. Until next time, we do look forward to you joining us again for future educational webinars. Lev, thank you. Thanks everybody, and enjoy the rest of the day.
Thanks.